Now, good day, ladies and gentlemen, and I would appreciate it very much if you could click down below on the icon and on the bell icon or on the subscribe button. I promise you, we won't barrage you with emails. The only thing you'll get is a notification when I upload a new video. And your subscriptions are very, very important to me so I can keep building this channel. So please click the subscribe button. I appreciate it greatly. Now, today we're going to touch on a taboo subject: risk management. Now, as many of you know, I'm an old guy. I've been trading since 1972. And when I was a kid, there were lots of things that were taboo. You know, when a woman was with child, you didn't notice it. You didn't mention it. It was taboo to say anything till after she gave birth. I don't know why. There were just certain things that were not said in proper civilized society. Today, we pay no attention to it. The world's changed. And I'm not here talking about society and culture, but I am talking about a subject called risk management. And risk management is the taboo word in forex trading when it should be the most worshipped concept that you have. Now, many novice traders begin trading without a trading plan. And this is one of the primary reasons why the vast majority of new traders lose money. Even with a trading plan, the plan lacks a good risk management component, regardless of how well the plan may work initially, a trader can eventually, and will most likely eventually, lose everything. Now, believe me, I have a lot of subscribers on my two channels. I also work for a lot of brokers. And a lot of people hear me, get to know me, through my seminars and webinars. And you know what? I get so many emails attacking. You know, Forex is a con. Forex is a ripoff. This is a scam. This broker's a scam. Yeah, there are scammy stuff somewhere in this industry, but every business has scammy stuff. But the fact is, when I write back to this trader who's either assailing me, assailing a broker, assailing the industry, and ask them how much experience do they have, how long were they trading, okay, how did they understand risk management, how did they set their risks, and I find out, well, they lost all their money in 2 weeks. They never put a stop loss. They never thought about loss. You know, and they said, oh, well, you know what? I can get 50 to 1 leverage, so I've invested $1,000, tied up $50,000 in a trade. Was going to get rich in a second because I knew oil was going to go through the ceiling. But I ended up losing all my money in about 15 minutes. I said, and you want to blame everybody else? I said, before you ever risked your money, did you think about managing it, protecting it? Would you go down the street and hand a bum on the street corner $1,000 if he told you he'd bring you back $50,000 a couple hours later? Well, your broker's not a bum. Your broker's a respected businessman, but he cannot make you do anything. He can educate you, he can train you, he can share information, and most likely almost every broker today offers a demo platform. If you don't want to learn before you invest, then the only person that's scamming anybody is you. And risk management is the most important concept that you can learn. Strict money management and risk control is the essential to achieve long-term success in the markets. The high level of leverage available to traders makes it important to manage risk and to avoid over-leveraged positions. Successful money management aims foremost at the preservation of your initial trading capital. What's that word I just used? Preservation. Okay. This is ultimately important. A trade that's going to make you rich, and there are no such things, can also make you just as broke. So if you think you're going to make $50,000 from a trade, you also have the same mirrored exposure, $50,000. So before you start blaming everybody, stop playing the lottery. Now, leverage in our industry can be deathly. Leverage makes trading worthwhile. But when you think that you can take $1,000 and spin it into a $50,000 trade and make a fortune, you have to understand what you're doing. Leverage can be defined as the amount of a trading position you can control with a given amount of margin or deposit. Also, the leverage ratio is the ratio of the amount of leverage to the amount of margin. In practice, a leverage ratio of 50 to 1 would mean that you could control $50,000 worth of a position with just $1,000. While professional forex traders generally trade using the credit lines that banks and their counterparties extend to each other, retail forex traders like you and me have to master the concept of leverage because we don't have the cash to back us up. You know, if Citibank invests in gold and they think gold's going to go to $1,800 and they're buying it $1,650 or $1,750, well, they're paying cash for it. I mean, they're not writing a check. But they're not going to have a margin call. If gold goes up from $1,650 to $1,700 and they've got several $1 million worth of gold, they did good. But if gold for a few minutes dips from $1,650 down to $1,600, they don't have to run to the bank and take a loan to pay the broker because they're upside down. They're huge. Okay. And in most cases, they have the cash. In all cases, they have the cash to cover their positions, whereas you don't. So what happens is when you make that $50,000 trade with your $1,000, the broker, who's required by law and regulation, is to never let you be upside down and negative, needs you to deposit more money if your position, the value of your position, falls below $49,000 because you put a $1,000 deposit on a $50,000 trade. Now, he can require, if it only fell to $48,000, he can require you to put in another $1,000 in your account. That you might do, but you have to be able to handle the swings of the market. The market isn't a ladder that you just run up. Okay, the market is a ladder. You step up 1 step, 2 steps, 3 steps, and you slide down 2 more steps, and you slide up 3 steps, you slide down 4 steps, and you're hoping by the end of your trading session you've climbed to the top of the ladder or to the 5th step and you can close out. But you have to be able to cover those times you slip down the ladder. And trading is all about managing your risk. Statistically, you will have successful trades. So on your unsuccessful trades, your losing trades, if you can limit your loss at all times, that means the successful trades you do have will offset those losing trades and you'll net out a net profit. So naturally, this high leverage ratio can act as a two-edged sword since losses can accumulate as quickly as profits. Furthermore, traders need to keep close track of their margin requirements. Now, what will happen is I see new traders and they're making small trades. Okay? $200, $300, $400, $500. But before you know it, they got 5 positions open. So yeah, they made small trades with little bits of risk. But when you look at all, I'm so sure the euro is going to go up. I've opened up a trade of euro dollar, I've opened euro yen, the euro against the pound. And they're all $200 trades. But in the end, when you add them all together, you got $1,000 of open trades on the platform. But you say, $200, I can float it. I don't need to put a stop loss. If it goes against me, so what? I'm out $200. But what happens if all 5 of them go against you simultaneously? So you need to adopt and maintain a neutral trading style. Okay. You need to have your risk management rules written down and adhere to them. Not just decide them trade by trade by trade. You need to be able to stay detached and objective. So, let's go some guidelines. When losing in a trade after trade, lower your trading size by 50%. Trade smaller until your winning streak begins. So even smaller if needed. And, we say this isn't about luck. The whole life is about luck. You went and applied for a new position and you were turned down. Even though you have all the right credentials and everything else, the person who went who wasn't as qualified as you the next day gets hired. Was it? Why? Well, maybe the guy who was interviewing had an argument with his wife on the way in. And so he was just in a negative position. So it was your luck or your bad luck to hit him on a bad day. Maybe if traffic was bad on the road and you were his first interview, that's all luck. Okay. Having the best interview, having the best resume isn't luck. I mean, eventually you will find a great position. But you need a little bit of luck. Like in the early 1980s, I was trading only agriculturals. And 82, 83, 84, everything I touched turned to gold. And it did. I mean, money was flowing in. I was trading my own account. Money was flowing in so fast. Believe me, I was spending it as fast as it was coming in. You increase your lifestyle, you have to make more money. You have to make more money to increase your lifestyle. It becomes a vicious cycle. 82, 83, 84. By end of 84, this little lucky thing on my shoulder turned against me. So the same trade I was making in 84, same strategy, same everything, was losing. By 85, I was chasing my positions because I needed to cover my monthly nut as well as make profit for the people who had given me money into the fund. And by 86, I was dead broke again. Why? That little angel on my shoulder disappeared. That little edge. If I would have been smart and followed the rules, and in 84, when things started edging against and started cutting my positions back or taking closer risk management rules, cutting my risk farther and farther, guess what? I wouldn't have lost everything by 86. I might not have made much, but I wouldn't have lost everything. So you need to learn only to risk 1% of your capital per trade. Okay. Now, again, we have the guy who's taking his $1,000 and breaking into 5 trades. Okay. Don't find ways to circumvent it. Stay disciplined all the time with your entry and exit points. Don't get sloppy. Do not abandon your method. You have to stay the course. So when your method comes back or your strategy comes back in favor, you start having successful trades again. Too many people just keep adjusting and keep changing. Now, there's nothing wrong with updating your strategy. There's nothing wrong with having multiple strategies. But when you start to find or force yourself to have a trade or stay in a trade by changing your strategy for this one time only, you're going to find out you're in trouble. And don't take losses personally. It's not your fault that the market is not conducive or conducive to profits. Now, back in my college days, I did telemarketing. I was a fundraiser for the Democratic National Committee in the U.S. And I always had the gift of gab, so I didn't mind talking on the phone. And it was a great job because it was down the street from my school, and after class, even if I had a 2-hour break between class, I could go down there and work for 2 hours. Okay, go back and do my class. And it was very flexible. It was very, very nice. Some days you have good days, some days you have bad days. Some days people hang up the phone on you. Some days people are very charming. Some days you end up talking to some little old lady for an hour and get nothing, and you realize you've wasted an hour of your time. I was having a bad day one day, and my boss came behind me and said, "What's up?" I said, I've been here for 2 hours, haven't raised 1 cent. I've had nice calls, but haven't gotten anywhere with any. I don't seem to have my edge. And he said to me, kid, I've been doing this a very, very long time. I'll tell you one of the most important rules of the game. Not every call is going to be successful. But if you realize that you have to make 10 phone calls to get a successful donation, You got to get through those 9 phone calls before you're going to get success. So if you think of each one of those hang-ups, each one of those little old ladies who wants to chat, each one there's one step closer in the process of getting that successful donation, you'll have it made. So don't think of the hang-ups, the call me back laters, the no's, and everything else as bad things. Think of them as good things. But what you have to learn is not to waste your time. Don't spend an hour talking to that little old lady because you think she's going to say okay to $25. Okay. So set up your rules. Set up your introduction, set up your speech, set up your killer when you're going to get the money. Yeah, you can go outside, but the best thing I ever did was put a timer on my desk. Never let a phone call go more than a certain amount of minutes. And you know what? When I started to understand this, started to follow the rules that he was giving me, the guidance he was giving me, I became a much happier fundraiser. I became a much more successful fundraiser. By my third year of college, I was on the VIP donors list. Only the people that gave $50,000 more to the Democratic National Committee. I was talking to corporate executives. Remember, this is in 1972, 73, 74. I was talking to corporate executives. I was talking to doctors. I was talking to lawyers. I was talking to the cream of the crop. So instead of talking to a little old lady who was trying to get $25 from, I'm talking to guys I'm trying to get $25,000 from. So my commissions, my bonuses went sky high. Okay? But it took all those years of experience and expertise and getting there and developing my rules, my strategy. By the time I finished college, I had saved enough money to go on to grad school. So do not fall into the temptation to let losers run. Cut your losses at predetermined stops regardless of the pain. Say goodbye at 4.5 minutes, regardless of if you think you're really going to get her. Do not stop tracking your watch list for the market you trade. Be ready to take the right entry when it presents itself. Many traders get so upbeat up on a string of losses that they stop focusing on their watch list and stop taking high probability entries. So control is always what's important. Where you want to be is always in control. And go easy on risk. And I'm sorry, I mentioned at the very beginning, this is a taboo subject. And before we talk about how to set your risk-reward ratios, we need to instill in you how important this is. Online trading is set up to be a rather risky endeavor. I always encourage new traders to go easy on risk as they get started. And always remember, every penny of reward is mirrored in a penny of risk. The system overall is somewhat encouraged risky behavior. And that's the problem. And too many people get sucked into it and they want to blame the system. The number one thing that you can do to manage your risk is to never trade money you cannot afford to lose. Don't think about your tax refund, your bonus check, the extra money in the bank. Whatever amount you've put into your account is your expendable cash. Yeah, you might have put in 1,000 when you have 10,000 in your little fun kitty. Like I have a little kitty that I have, but if I want to buy a new TV, if I want to buy some new shoes, not ones that I need. Okay, buying the new suit because I have a wedding to go to is much different than walking through the mall and seeing that beautiful blue suit or seeing those incredibly hot shoes that you just want because you want. That comes from my rainy day kitty. Okay. That rainy day kitty is also what funds my forex trading, so to speak. It's the fund that I have it's expendable. I can expend it any which way I want because at this point, you're a newbie. Even if you got a year's experience, 2 years experience, you got to be using expendable cash. Okay, not cash you need to pay your mortgage, not the cash that's for the kids' college education, not the cash you need to use to fix the car. This is money, if it goes, it goes. So whether you spend it on a new pair of shoes, whether you spend it on a weekend away with the new girlfriend and you came home and you spent $2,000. Okay. It was expendable. It was gone. It was your happy money. Because you're not experienced enough at that point to be making investments, okay, and growth. Because in the early part, it's all about learning and education. And learning and controlling risk will eventually make you profit. And the second thing is to never let your eyes get too big for your stomach. You should never, ever, ever place a trade without a stop loss. Now, I talk to new traders all the time. Let's talk about the gold trader that we talked about before. Okay. Now, the central bank or the investment bank or Citibank or JP Morgan Chase bought gold at 1650 expecting to go to 1700. And gold went to 1700 late that night. JP Morgan made a ton of money. Now, you made the same trade at the same time. But you see, JP Morgan didn't care whether gold fell down to 1600 because they knew it in their hearts of hearts it was going to go to 70. And for them, a couple $1 million isn't anything. So they covered their drop. They don't have to do anything. You, on the other hand, got stopped out. Because what happened was that trade fell either below the stop loss you had placed to protect your losses, or below the amount in your account where your broker would allow the trade to run. Because in neither case are you allowed to lose more than you can cover. Now, what happened was you had the perfect trade. It should have made you money. The trick is how do I place my stop loss? Your stop loss isn't just a matter of your risk-reward ratio. Okay, what you have to do is first you have to calculate where you would have to put your stop loss, even if you had $1 billion, based on the swing and the volatility of the market. You then have to set your target, like JP Morgan Chase did, never this 1700. Okay. The difference between the risk and the potential reward is your risk-reward ratio. Okay. Now, if that risk-reward ratio is either too high, that means there's too much risk to the possible reward, or it's beyond where you could have put your stop loss, you don't make that trade. Okay. And there's many ways that you can do this. You have using trailing stop losses. You have all types of ways to place your stop losses. But here, let me pop up a chart. Now, here's the Euro US dollar. This is my teaching chart. Now, what I've dropped on here, okay, is actually a small little long trade aid scenario. So what I would do is I would place the top of this at where I thought my potential target would be, and I would place the bottom of this at where my potential stop loss would have to be. Not where it is in my risk management, where it would have to be. In this case, say I based it on the lowest swing low before the upturn. Okay. And I would need to place it here. So it's already calculated for me. The risk-reward ratio is 2 to 1. Okay. I could afford to make that trade at a 2 to 1 loss ratio. But say my target was really just about here. Well, all of a sudden, that's a 5 to 1 loss ratio. That's too much risk for my trade, and I don't make that trade. Okay, believe me, there's many good trades. There's many opportunities, but managing your risk wipes them out. Okay. There's always going to be a trade that fits your requirements. So the market is an incredible thing. It offers you opportunity after opportunity after opportunity. You only need to accept the opportunity that fits your rules the best. Don't think, oh, I'm never going to get an opportunity like that again. Or, look at that, I'm going to make so much profit. Doesn't work. Because you'll either get stopped out, because whoever predicts the market to reverse, whoever expects big swings in the market, whenever you don't expect, even though the trade went perfectly well, okay, Could you have been prepared for this movement right here? You had bought into the euro US dollar, say here, 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 here. Okay. You expect to go here, did exactly what you said. But guess what? We had this one small blip with this incredibly low low. And if you would put your stop loss, say, at your trend line, you would have been stopped out, and that winning trade became a losing trade. So it's always important to manage your stop loss and your risk-reward ratio. So trading with money that you can afford to lose in the worst case scenario, trading with reasonable lot size, controlling your risk with stops will prevent you from having a major trading disaster. These steps won't prevent you from losing money, but they will give you a chance that you will survive. Far too many traders take a Wild West approach to trading, and sometimes it works for a while, but when it's over, it's really over, and they tend to walk away with empty accounts and want to blame everybody else. Trading while keeping your risk low will keep you in the game and put money in your pocket at the same time. Forex trading is a legit thing. That's why it's regulated by governments, monitored and supervised. But you will have to be wary of your setup. You can make money if you don't get carried away and taking on too much risk. This isn't the lottery where you go and buy and say, give me 10, 42, 51 and hoping you and praying you win. This is not going to happen. This is about education, experience, risk management at all times. And learn to trade on a demo account. Don't get excited. Don't throw your money away. Get a free demo account and practice for a long time. Because speculating as a trader is not gambling. The difference between gambling and speculating is risk management. In other words, with speculating, you have some kind of control over your risk, whereas with gambling, you don't. Even a card game such as poker can be played with either in the mindset of a gambler or the mindset of a speculator, usually with totally different outcomes. So always calculate where your profit points will be. Don't get over greedy. Don't say, "Oh, I'm going to make $50,000." Okay, figure out where you'd want to exit the market. Okay, and where the market might go to realistically that you could exit your trade. You do this by looking at support and resistance levels. You calculate a real target. You don't just guess. And then you calculate where you would have to put your stop loss to cover the volatility and the swing in the market. Then you calculate your risk management from that. And then you filter out the trade, whether you can afford to make it or not. Going back and looking at it later, saying, I could have made $1,000 is a waste of your time. So, however, no trade should be taken without first stacking the odds in your favor. And if it's not clearly possible, then no trade should be taken at all. Now, you can do things like using hedges. Okay? There's all different complex things, multiple currency pairs. Okay? But remember the rule, the 2% rule. 2% or less per trade is highly recommended guideline. There's many things you need to learn. And demo trading, using education and experience, learning the markets, okay, is what it's all about. And minimizing your risk per trade. So another way you can increase your chance of profitability is to trade when you have the potential to make 3 times more than you are risking. A 3-to-1 risk-reward ratio. Okay. So always calculate what your possible losses and what your possible profit will be. If it doesn't come out, and I say in the beginning 4-to-1, don't make that trade. There's always another trade to be had. And you need to understand how you set risk, because you also have to factor in the pips, the buy and the ask. There's many things you need to know. Now, you can also reduce the size of your trade to minimize your risk. But in the real world, reward to risk ratios aren't set in stone. They must be adjusted depending on the time frame, the trading environment, your entry and exit points, your knowledge, and your experience. So risk is inherent in every trade. But as long as you can measure risk, you can manage it. Just don't overlook the fact that risk can be magnified by using too much leverage in respect to your trading capital. With a disciplined approach and good trading habits, taking on some risk is the only way to generate good rewards. So thank you very much for joining us, and have a great and successful trading life. Bye now.